Hello, welcome to my economic update for the second quarter of 2024. Today I'm going to cover a number of familiar topics. We're doing so in quite a different landscape than we had in the first quarter of 2024. So we've seen the adjustment in expectations around inflation and interest rates happening weekly, almost daily. And that's changed from the expectations when I did an economic update back in February. So we're going to cover the categories of the economic landscape. We'll talk about interest rates, inflation, and bonds. We'll always talk about stocks and what that environment means for stocks. And finally, I want to address the election. And for those of you who hang on till the end, I've added a bonus section about really just focusing on what really matters, what's important beyond all of this economic information. So let's dive right in. As I mentioned, the economic landscape has been changing. And at the beginning of the year, there was this argument that we were definitely on the way to have a soft landing. And the soft landing outlook has changed quite a bit because the data has changed. I mentioned in the first quarter that we're going to see some volatility around month-to-month data releases, which includes inflation and jobs primarily. And we also see some ISM or leading indicator PMIs that I'll talk about in a minute. But we're getting conflicting signals. So inflation has been stubborn. It actually ticked up a little bit where it was expected to stay flat or continue to trend down. The bond market and the interest rate market adjusted immediately to that data release. And so we saw bonds have kind of a crummy quarter and interest rates go up again where they were expected to stay flat and eventually start to go down. But let's take a look just at the overall economy and GDP growth, because this is also an interesting point from the first quarter. GDP growth slowed, and it slowed more than expected. So the GDP growth in the first quarter was 1.6%. This is below the 2% trend line that we've seen for the last 25 years. The Federal Reserve, who created this slide, is projecting us to stay around 2%. But if we get another GDP release that shows weakness in the economy, that will change what the Federal Reserve might do with interest rates. They might drop interest rates. However, there's also been this argument that we actually have to see a recession to fully tackle inflation, which we saw the last recession in 2020. And that really means 2 quarters in a row of negative GDP. So the soft landing argument was that we wouldn't have to see a recession to tackle the inflation problem. Inflation still is down from where it was over the last couple of years, but it hasn't really budged in this last quarter. And that's what's created some of this volatility in stocks and bonds and expectations around interest rates. Let's take a look at the leading indicators to see, is there a recession on the horizon since we've seen this slowing GDP growth. And the first one we'll look at is manufacturing. So this is about 1/5 of the economy. And the way to read this chart is that if the blue line is under 50, and you can see we're right at 50 at the end of March, it means that if the blue line is under 50, you're going to experience contraction in manufacturing. If it's above 50, you're going to experience expansion. And right now, this leading indicator is not telling us much about whether or not a recession is on the horizon. Let's take a look at the services PMI, which is 4/5 of the economy. And you can see it is positive at 51.4, but it has been trending down. Personally, I think this is due to the fact that a lot of the services growth that we saw after we were able to get back out after the pandemic, there was a surge in services. And these are things like travel, leisure and entertainment, going out to eat. We were doing a lot more of that just because we hadn't been able to do it and we had more money in our pockets because of the stimulus payments. Those things are running out. And when you really consider how much it costs to travel or go to a restaurant, we're starting to see people paring back in those areas. So that's why this PMI, I think, is trending down. And it's indicating to us still expansion, but not dramatic. And they don't expect a contraction yet. I think we're going to see movements in both of these PMIs on a month-to-month basis that will give us one of the best insights on whether we will have a recession or not. The consumer is one of the big reasons that we haven't seen a recession. Let's take a look at the strength of the U.S. consumer. And so there are a couple points on this slide that I want to highlight here. So in the upper right, we'll look at that excess savings that was driven by those stimulus payments, and it's continued to dwindle. And we see that there's still some left, but it is definitely heading down. The real data point on this slide is actually over here on the left. And this is what caught my attention. We've seen the personal savings rate down under 5% for 3 quarters in a row. And that is stimulative. If the savings rate is under 5%, it means that consumers are feeling free to spend. That will continue to drive economic growth. And so it makes sense that this economy up until the first quarter had been surprising to the upside, showing strong growth or staying power. That might be coming to an end. Let me show you one other data point that leads me to believe that. This slide talks about consumer debt. I want to focus down on the bottom right here, and this is showing delinquencies on auto loans and credit cards, and you can see those delinquencies have been trending up. We're not quite where we were in the Great Recession of 08-09, but this is, again, to me, a leading indicator of, okay, the consumer probably is starting to run out of that excess savings right now. And this bears watching because if they're already hitting delinquencies, there's no real dry powder for consumers to go out and start spending even more. I don't think the consumer's getting stronger from here. Probably will be getting weaker from here, and we will see that continue to be reflected in weaker GDP growth. Let's now turn our attention to interest rates, inflation, and bonds, showing the impact of what the Fed is doing and what they potentially will do from here, because that's changed quite a bit from this first quarter. Let's start off with what I thought was a timely cartoon. And there's this idea of inflation and then perceived inflation. So inflation has started to come down, but when you go to the grocery store, it doesn't feel like it's come down. And that's because the prior inflation we experienced is here to stay. The prices we saw before aren't going away. They're just not going to increase as rapidly from here. So that's a little bit of the depressing story. And it's why we don't see inflation as coming down perceptually when we go to the grocery store. But let's look at the actual trend of inflation. And you can see here that inflation definitely has trended down from the peak back in 2021, 2022. And the important number on this slide is what's called the headline PCE deflator. And it is here on this table in the upper right. And this also explains a lot of what happened in the first quarter with interest rate expectations. So the reason the headline PCE is important, this is the number that the Federal Reserve uses to determine the rate and trend line of inflation. And the 50-year average has been 3.3. The Fed wants it to be 2%. And so in February, we saw it tick down to 2.5. But in March, it unexpectedly ticked up to 2.7. And when I say unexpectedly, the trend stopped. And it indicated to the market, hey, inflation might not get tackled based on interest rates, where they are, and what we think the Fed is going to do. So the way this was interpreted by the market and the interest rate market and the bond market is that, hey, at the beginning of the year, we thought the Federal Reserve would start dropping rates by May or June, and we will see 6 rate drops by the end of 2024. That was the soft landing argument. The March headline PCE deflator number threw that out the window. The expectation for rate drops now is that the Fed will hold rates higher for longer. In fact, today is a Fed meeting day, May 1st, and that's what they're expected to say this afternoon. but the market is adjusted and thinks that there might only be one or two rate drops. And if there are, they'll happen in the fourth quarter of this year. This slide shows us what the Federal Reserve is projecting and then what the market is projecting. So the blue line is what the Federal Reserve is projecting, and you can see that they're projecting some rate decreases to start the very end of this year and then move into next year and consistently come down, but relatively gradually from here. The market is pricing in a more gradual drop in rates, with higher rates sticking around for longer. And this is quite different than what the market was predicting back in the first quarter. I believe that the market is correct on this. I thought the market was wrong when they expected 5 to 6 rate drops this year. It just gave no room for error. And at that point, economic growth and job growth was still strong. As I showed you, those are starting to weaken a bit. They're still positive, they're just not as strong as they were. And the Federal Reserve is looking at both that job growth and the GDP growth and inflation to determine what they do with interest rates. Nothing out there today suggests to me that they're anywhere close to dropping interest rates. But the feeling from here is that the likelihood of them increasing is much lower than the likelihood of them dropping rates. So what does that mean for us as investors? Well, we really see this reflected in performance of the bond investments in our portfolio. So I'll share with you one more slide from this section, and we'll take a look at the impact of increasing and decreasing interest rates on bond returns and bond prices. So this table on the right is what we want to look at. And the expectation, again, is the higher likelihood that rates will drop. And so I want to look at the blue bar here to look at if rates dropped 1%, what is the potential total return for different types of bonds and different maturities of bonds. So you can see here in the 2-year U.S. Treasury, if rates dropped 1%, the expected return for a 2-year Treasury would be 6.9% in that scenario. Let's look at the 5-year Treasury. It's 9.1%. The 10-year is 12.5%. Those are approaching stock-like returns, which is not the norm. In fact, looking back over the last 73 years, at this table up on the right, you can see that bonds have averaged a return of 5.3%. So we are in a position where I really like the opportunity that bonds are providing in the portfolio. And when the Fed does start dropping rates, we should see that positive impact on our bond holdings. The magnitude of that impact will be based on how rapidly the rate drops happen, and that we just don't know quite yet. I think by the end of this year, we'll have a much better perspective on what that might look like. Let's turn our attention to the stock market. Pretty good start to the year. Just looking at the first quarter, you can see that U.S. stocks had a great first quarter, up 10%. International, called developed, excluding U.S., up 5%, so about half as much. Emerging markets didn't get as much return, only up around 2%. Bonds were slightly negative in the U.S. and slightly positive outside the U.S., and that was because of that big interest rate adjustment around expectations for 2024 and those rate drops going away. So not as much return on bonds so far, but as I showed, I think the future looks pretty good for bonds. And then when we split the market out a little bit more finely, you can see that large cap stocks greatly outpaced small cap stocks. And that's something you see really in mid-cycle returns. Small cap stocks tend to outperform during the first part of a new bull market. Large cap stocks tend to take over in the middle of that market. Value stocks and growth stocks, very similar performance, although on a day-to-day basis, the volatility in those two has been fascinating. But when you just wrap it up, the first quarter, value slightly outpaced the growth stocks. And then one other factor is profitability. So when you look at the companies with the highest corporate profitability relative to the overall market, those have outperformed. And that's a meaningful part of when we look at putting together your portfolio. That's something that we also factor in. and overweight higher profitability companies in the portfolio. So great first quarter, but for many of you, it might not feel like it because April, not so great. In fact, April was the first month in the last 6 that was a negative month. So we had a 5-month run where we had great positive returns, and then we gave a little bit of that back in April. But when you look at just year to date through really the end of April, or pretty close to the end of April, I'm looking at April 26th here, stocks were up 7%. At some point during the year, so I'm looking at the far right side of this chart, stocks were down 5%. It's always with markets, you never have a straight line up. It feels great when it feels like it's a straight line up, but you're always going to have some modest pullbacks. This doesn't even qualify to be a correction, which would be a 10% pullback. It's relatively normal volatility in any year. And I think given the huge adjustment in interest rate expectations, stocks have been very resilient. Let's look at valuations overall. How are stock prices doing relative to history? And so that's what this chart is showing us. And so when we look at the gray line, if the gray line was in the middle, it means the stocks are fairly priced versus the last 30 years when you look at the average. And when you approach the top line, it shows that stocks are getting slightly more expensive than history. My takeaway from this slide is that stocks are priced for things to continue to do well, and anything that upsets that outlook will have an impact of higher volatility and maybe a pullback in those valuations. Said another way, a pullback in stock prices. Now, one way this line can get pulled down is if companies start to do better than expected earnings. And LPL put together this earnings season dashboard I really like, that at this point in the cycle, about half of the companies, 230 of the companies of the S&P 500 have reported, and 60% of them have beat their revenue estimates. 80% of them have beat their earnings estimates. So in that environment, you start to argue, well, maybe these valuations are appropriate. And that's what we want to see in future earnings seasons. If we continue to see upside surprises or beats, then those valuations probably are staying where they are. Where are the opportunities in markets? Well, still in, and have been for a long time, international stocks. So this chart shows the cycle of U.S. outperformance versus international stock market performance. And this gray mountain that you're looking at on the right shows that U.S. has been outperforming international for over 14 years now. We definitely navigated the post-pandemic economy better than many international economies did. But at some point, you think there will be some reversion to the mean. And if you look at this, if the blue mountain exists, it means that international has outperformed the U.S. So, before this latest 14.2 year period, international outperformed for 7.2 years in a row. But this outperformance, you'd have to go back to the mid 80s to find outperformance on a percentage basis, 277% better in U.S. than international than we've seen. So I'm still beating the drum for international. The strong dollar has delayed this a bit. I think as the Federal Reserve starts to drop rates, the dollar tends to weaken, so that could help international. But just on a pure valuation standpoint, I am always interested in what people aren't interested in. Like, what is the most value out there? What seems most discounted? People aren't interested in buying, and it's international. If you look at this chart on the left, and it's very similar to the valuation chart that we saw with U.S. stocks, but it's comparing U.S. and international. Very simply, if this gray line is below the middle line, it means international stocks are cheap relative to U.S. And we are now 2 standard deviations away from that center line, which is a huge discount relative to U.S. So I still think there's quite a bit of opportunity in international that we'll be happy with when that does happen. That said, we're always going to own U.S. stocks. In fact, the stocks in our portfolio, the majority are U.S. stocks, but we do have representation of international, which I think is going to bear fruit for us when you look over the intermediate term, maybe the next 5 years. Let's move on to the election. Because the election season might be so stressful for many of us, I found a timely cartoon that I think reflects how a number of us might be feeling. I don't want to talk about any particular party or what the outcome of the election might mean for markets, because that's just such a great unknown. But I do want to address one of the common topics that's discussed during an election year, which is the Federal Reserve a political animal? Will they make adjustments to interest rates to favor one party or another? The thinking is, well, gosh, if the Federal Reserve starts to drop rates just to boost the economy, they're trying to keep the current administration in line. So I want to show you a slide that I think disproves that point. Going back to 1980, you can see here movements in the interest rate. So monetary policy changes for each election year since 1980. And the thing you'll see is there's only been one year where there was no monetary policy change. The Federal Reserve is clearly focused on the economy and what their mandate is, which is healthy job market, low inflation. And they will do with interest rates what they believe necessary, regardless of the timing. And I feel confident about that. So the arguments that it's politically motivated, I just don't believe. But let's talk about the markets and what they do typically in election years. So let's focus here on the chart on the right. And it shows you typical stock market performance in each year of a presidential cycle or presidential term. So in the first couple of years, the average returns around 9%. The third year of a presidential cycle tends to be the most rewarding. We just experienced that in 2023. In the fourth year, we tend to see high single-digit returns in equities. And so far, I would argue that we have experienced the beginning of that, but it really will come down to the economy. These are just averages. I find them interesting. As you've heard me say before, I don't use any of this to manage the portfolio. It's just a lot of folks have questions around the election and election years, and so I want to provide some perspective on that. All right, for those of you who have stayed with me through the entire presentation, or maybe you skipped to the end, I want to share with you a concept that I've used to help me stay focused on what really matters. Because in today's world, there's a lot of outside influence via news and other things that can be a little bit discouraging. So we want to focus on the things that we can control and let go as much as possible of the things that we cannot. Every quarter, I attend a workshop run by Strategic Coach up in Toronto, Ontario. Strategic Coach is a program that works with entrepreneurs. And Dan Sullivan, the founder of that program, developed a question. In fact, he's written a book about it that can have such a meaningful impact on your life if you give yourself time to sit and reflect on it. And in fact, if you've started to work with me within the last 10 years, this is the very first question I ask you in our initial meeting, because it helped me understand more about you, who you are, and what your priorities are. So I'm going to share this question with you now. So if I was sitting here 3 years from today, and this is what I would write at the very top of my notebook page when I do sit down and reflect on this question. If I was sitting here 3 years from today, and I was to look back over those 3 years to today, what has to have happened both personally and professionally for me to feel happy with my progress? Such a powerful question. And if you ask yourself this, give yourself time. Don't do it in a rush. I often go to a place where I know I'm not going to be disturbed. Let me share with you one personal outcome of asking myself this question. One answer I had was I wanted to be more intentional and proactive with spending time with my family. And from that, I created this idea of having a family reunion with all of our family members who are spread all over the country. So I have family in Vermont, Michigan, Missouri, Oklahoma, and of course myself in the Carolinas. And I said, wouldn't it be cool if we could spend a week together? Because many times we just don't see each other. And so I went out with my two sisters and we found a big house to fit all of us and rented it for a week. That first reunion, 28 family members from 4 different generations showed up. And I've got to tell you, it was such a great week to see everybody, to have so much fun together, see the cousins growing up together that don't see each other very often. So we decided to do this every 2 years. And the last family reunion we had, there were 38 of us. So now our challenge is finding a big enough place where we can all stay together. But I'll let you know, we will find a way to get it done. So I hope this question has as much impact for you as it does for me. I wanted to share that with you as a wrap up. This is to me what's most important. All right, so thank you for your time and attention again today. If you have any questions or comments, please reach out to me. For compliance purposes, I cannot open the comments section on the YouTube page, so I always want to be compliant, and that's why you're not able to do that. But again, thank you for your time. Hope you all have a great day.